This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Patrick, I want to move on to our post-game chart deck, which is titled Talking Charts. Listeners, you'll find the download link in your Research Roundup email. Now, if you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, click the red button that says Looking for the Downloads. Patrick, as per normal, on page 2, we've got that S&P 500 continuous futures contract chart. What's that telling us today?
Well, you know what? I wanted to really touch on the three equity markets I like to track in the U.S. with the S&P 500, the NASDAQ, and the Russell on pages 2, 3, and 4. And it's really interesting. There's a bigger story that seems to be going on where suddenly a lot of the cyclicals and small caps have started to give back a lot of their gains. And it was like the FANGs and growth stories were really starting to gain some momentum on the upside. And so what you can really see is an S&P 500 over the last 2 weeks that's been relatively flat. But when you look at the same 2 weeks on the Russell on page 3, it's been in an outright correction on the downside, while it was only a day or two ago where the NASDAQ started to actually show signs of reversing off of its top. And so the question in my mind is will this trend continue? Will we continue to see a lot of these growth-driven narratives act as leadership and lead the way? And will the small caps return back to underperforming? And it's one of the questions I have. Like the thing that I want to touch on the S&P chart on page 2 is that what we've seen this year is on 8 occasions, we either saw a correction that returned back to the 50-day moving average, or in the case of the September-October correction, temporarily traded below it. And so in the past, we've typically gone about a month or more before at some point the market has some sort of a pause in its advance and kind of corrects downwards towards its 50-day moving average before setting up another advance. With the fact that we've failed to hold the breakout on the S&P, the question now is, are we going to see a dip back toward that 50-day moving average, which lies just under 4,600 before the bulls resume the upside? It's certainly on my mind when looking at the charts.
Patrick, on the Euro-US dollar cross on page 5, I know you were watching one spot 15 or so on that cross up. It didn't hold.
Yeah, actually, we were targeting a move down to 113, and we blew right through it. And we're seeing an outright acceleration to the downside. The bears have just really are running with the breakdown of the euro. And when you zoom out, it's not captured on this chart. The last major support lines were all the way down around the 108 to 110 area. The question with this kind of downside momentum, is this still got another couple hundred pips to go before we start seeing support holding underneath? It's quite oversold already. Typically, we would already see reactionary bounces, and it just seems to be almost accelerating to the downside. But what I wanted to touch on page 6 is just like you were suggesting during the market wrap at the beginning as to the potential dollar move that could be underway. When we look at like a 3-decade-long monthly chart of the dollar index looking really zoomed out, you can see that while the dollar rally we've seen is this little green candle that's turning up and certainly looks bullish, the thing is that we were still in the middle of a 5-year trade range. And by being in this 5-year trade range, we haven't really seen a decisive new bull trend resume yet in the dollar index. But it really does put the question of how much potential upside there is if this really did start building momentum. I mean, when we see some of the past dollar rallies, whether it's back in the kind of 2014-15 period, or whether you look back to the 1999 period, there's periods when the dollar really started to gain some traction and really bull trend. Is this just going to bounce around in the trade range, or is it going to break out to a new bull trend that runs this 10 plus points? It's a really interesting thing to observe here.
Let's move on to Bitcoin on page 7.
Right. And so what I wanted to just highlight here is we've now, for the first time since the October rally started, we are seeing that we're in the midst of some sort of a market correction. What is interesting here is that as Bitcoin slowly approaches this kind of 50 to 55,000 pocket, there's all sorts of support and fib zones and things like that lie in there. It'll be really interesting to see whether the buy on dip continues and whether this type of a market correction like it did back in September just spur the buy on dip traders to come in here and turn it. And this, I think it's a really interesting moment where Bitcoin can in some degree or another put in a turn point. It'll be interesting to see if it plays out.
And we've got crude oil on page 8.
Yeah, with crude, the interesting part, I mean, you were making the observation yourself just about the way the price action's trading. For me, I actually am really focused on the 80 handle. And I think the $80 level is really interesting on this contract because generally, if the bounce that we saw in the last few days was just a reaction from an oversold condition, then if there's more correcting and more selling to come, we should see crude oil fail below $80. And if that's the case, could we go back and retest 75 or even get into the low 70s? It would all be on the table. For me to really decisively turn back to the bull side of oil, I want to see that clear the 80 level on the upside and really, once again, put the bulls in control of this trend.
I agree, Patrick. I think there's a good chance that the bottom could be in, but that's only if we're done being stupid at the government level with policy, and I don't think we're done yet. I'm kind of eyeing the 100-day moving average all the way down at 72.88, just below $73, is where the downside potential might be if we see some kind of announcement or intimation that an announcement is coming about either a export ban or some kind of price controls, both of which are dumb ideas that are not going to solve anything, but it doesn't mean they won't be considered. Let's move on to uranium on page 9.
Yeah, we had that explosive rally in that Sprott Physical Uranium Trust back in September, and that really kind of overshot. It's clearly in hindsight we can say that. And we basically have now spent several months backfilling and consolidating that breakout. But to me, seeing a sequence of higher lows as it seems to be accumulated quietly here. And what will be interesting to see is whether or not this becomes the platform for another leg higher in uranium. And just like crude oil at the 80 handle, I think watching the Sprott Physical Uranium Trust around the 16 handle will be really interesting. If we can see 16 broken on the upside, it may re-resume this bull trend in motion.
Let's move on to the 2-year Treasury yield on page 10.
Eric, we talked a lot about that 10-year yield, and really the 10-year has not cleared its 52-week high yet. But what we clearly can see is that the shorter duration bonds, particularly this is the 2-year, but it's the 5-year is moving at the same time. What we're seeing is that they are distinctly pricing in rate hikes and just ripping to the upside on the yields. And the interesting byproduct of this is that it's actually put in motion the flattener. And so when you look at page 11 and we look at the 5/30s yield, I just cherry picked this one. What we continue to see is the yield curve continues to flatten. And, if you told me that we would have had this inflationary environment that we're in and asked like whether or not we'd be seeing steepening or flattening in that environment, I would have never guessed that this would be going underway. Like just the fact that the yield curve continues to flatten, the question is, are they pricing in policy error at some stage in terms of what everyone is projecting forward? It's really interesting that this trend is in play.
And also in play is the free trial at bigpicturetrading.com. You can get the information on page 12 and 13, or just go to bigpicturetrading.com to try Patrick's service, where you can get Patrick's chart decks every single day of the week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.